Hi everyone, this is Jason Burek of Wall Street for Main Street. Welcome back to another Wall Street for Main Street podcast interview. Today's special guest is a returning guest. He's a former software entrepreneur, he's a hedge fund manager, and he hosts the popular Macro Voices podcast, which is climbing up the charts on iTunes, and it's for financial professionals and very sophisticated investors. Erik Townsend, thank you for joining me again.
Jason, thanks for having me back. It's a pleasure.
Now, Erik, a lot is going on in the oil market right now. It's kind of surprising given how the dollar is strengthening. So when we're recording this on Friday, May 18th, 2018, we have WTI above $71 a barrel, Brent crude above $78 a barrel, almost 79. Do you think the oil market is in a wide, do you expect the oil market to stay in a wide trading range for a while, or do you think something different is happening right now?
Well, I think it's really hard to call because nobody knows for sure what's going to happen geopolitically. And my view is the market is, boy, we've really rallied quite a ways, more than you would expect on any kind of normal fundamentals. And I'm convinced the reason for that is entirely the Iran-related geopolitical risk. Thing is, that's very real risk, and I'm not sure it's over yet. Now, if an all-out war breaks out, you've got Israel, dropping major, air raids on Iran or something, you could very, very easily be back to $100 on oil prices before you know it. I think that it's probably more likely that we've seen most of the big escalation and it's already priced in. And if there's no further escalation, if the geopolitical situation calms down a bit, I kind of think oil prices have run up a little bit ahead of themselves and are due for some kind of correction. But I don't think it's a really massive correction. We do have a continuing geopolitical risk. At the same time, Venezuela is basically collapsing, unfortunately. My heart goes out to the people in Venezuela. But unfortunately, it also means that it's taking a lot of supply off the market. Venezuela has a potential output of as much as 4 million barrels. They haven't produced anything close to that in years. It's now at risk of dropping well below 1 million barrels a day of production. So there's a lot of reasons to keep prices elevated, and I think those could go on for a while. At the same time, if the geopolitical situation calms down, then I think we're overdue for a correction to the downside in oil prices.
Yeah, I'm totally shocked that Venezuela, that their oil production has collapsed when they went to, basically they seized the assets of all the private sector oil companies. They didn't reinvest any profits into refining capacity or increasing production, the prudent investments that the oil industry private sector would. So it's not surprising at all, given all the things that happen in Venezuela. We've seen this play out in a lot of different countries when they seize natural resource assets. But the oil market, there's a lot of other things going on besides just Iran. We have this record production in the Permian right now, and I did a short video on the oil market earlier in this year at the end of January, and I thought the oil price would go up in the short term. But are we at an oil price now, Erik, where there's going to be a lot of marginal supply coming online in the near future? So for the last couple of years, I know you cover the oil market extensively. Actually, I used to watch your peak oil videos when you did that special years ago. And I know when you were with Jim Poplava for a while, that Jim Poplava was interviewing all those peak oil experts. And I actually went back and listened to, I think, more than 50 or 60 of those interviews. So are we at a price now on the oil markets where that very high cost marginal oil production, the deep water offshore, is going to start becoming economic again?
Well, I don't know that we're quite at the point of deepwater offshore really getting economic, and tar sands is the other one that you really need a high oil price for. But where we are is at the level where the shale boom is back on with a vengeance. The Bakken now has reached an all-time record rig count. The rig count has increased in the Bakken to higher than it ever was in the height of the first shale boom. So things are really taking off. Permian Basin growth is taking off. And what we're seeing very consistently, Jason, is in the weekly EIA data releases, we're seeing U.S. production increasing to new record highs every single week. It was 20,000 barrels per day of additional production reported this week. Now, the thing is, that's 20,000 a day it doesn't sound like a big number. If you say 20,000 a day is added this week and more is going to be added this next week and more the next week after that, if you're increasing at the rate of 20,000 barrels per day per week, that annualizes to about 1 million barrels per year. Now, this week it was 20,000. Last week it was 85,000. That would annualize to 4.5 million barrels of additional production. So exactly what's the number? I'm not sure. It's somewhere between 1 and 5 million barrels of additional production coming online. I'd say probably 2.5 million is more likely, but 2.5 million, holy cow, that's not the total amount. That's just the increase that we're seeing in U.S. production. So as the price of oil at these levels enables more and more investment in the shale patch, they are going to drill the Permian Basin up like Swiss cheese and put in as many oil wells as they possibly can. That's going to increase production. And if at some point in the future we see things settle down on the geopolitical front, everything finally goes back to normal, well, you're still going to have the benefit of all of that additional oil production that was enabled by these high prices. So that feedback loop is very much in play, and it will take several months before the drilling that's going on now in the Bakken and the Permian turns into actual output. But even right now, we're seeing actual output, actual U.S. production increasing every single week, and I think that rate of increase is going to get bigger. So we're definitely at the point where shale has kicked into high gear. As far as deep water offshore and oil sands, maybe not quite yet, but that would be the next step.
There's been a lot of technological innovation and entrepreneurship in shale oil with the horizontal drilling and the fracking. So I know not all the technology is new technology, but there has been huge improvements, especially in the yield of the wells. And so I think that surprised a lot of people, myself included. And I was an oil and energy analyst, and we didn't see this U.S. becoming a resurgent oil producer. Do you think the Saudis don't want a higher oil price? Because I remember listening on your show that the Saudis had said that they were comfortable in the past with $60, $65 a barrel oil. They thought that price would prevent them from losing market share. What do you think? Do you think the Saudis are getting worried that the U.S. is going to take their market share now?
Something really weird is going on here, Jason, and I haven't figured it out yet. It was very clear for a while that Saudi Arabia was making public statements saying, hey, we don't want $80 oil. We don't want $100 oil. We feel comfortable that 60, 65 is about the right range. And there have been some reports leaked. Of course, you don't know for sure how accurate it is, but supposedly people that were in those closed-door meetings at OPEC in Vienna said that it was agreed among the participants, 65 is the target. We'll do what we can to keep it at 65. Now, a few weeks ago, there was a report that came out from, sources. Who the heck is sources? Well, somebody says that Saudi Arabia would welcome $80 to $100 oil, and that surprised everybody. And what was very interesting to me, Jason, is initially, right after that came out, about 3 or 4 days after, Saudi Arabia publicly denounced that and said, no, that's wrong. We don't have that view. We're not looking for $80 to $100 oil. That would be damaging to the market. That's not what we're trying to accomplish. Whoever attributed that quote to us doesn't know what they're talking about. Well, that was like 2 or 3 weeks ago. Now it's become pretty clear in the last couple of weeks. Saudi Arabia is very comfortable now that we're at $80 Brent. We traded over 80 in the last few days. I don't know if we closed there today or not. Probably not. But we're certainly 79 and change, and probably going to move back above 80. Suddenly, Saudi Arabia has been comfortable with that, and they weren't comfortable with it a few weeks ago. Well, what changed? Even I think it was the Iranian minister. Of course, Iran and Saudi Arabia have so much political and religious conflict. The fact that Iran says something about Saudi Arabia, you kind of have to discount it because you never know who has what agenda in terms of the messaging they're giving. But the Iranian guy, I think, said publicly, hey, last time we were in a meeting with Saudi Arabia and OPEC, they all said 65 was the number. All of a sudden, it's 80. We don't know what happened. I don't think anybody knows what happened, but it does seem that suddenly Saudi Arabia is comfortable with $80 plus oil. And that's a change. It wasn't that way a month ago. And I don't know what has brought it about, but it seems that suddenly the fear of enabling massive growth of U.S. shale production, which is definitely what's happening. We're seeing it coming out in the numbers. They're not worried about that anymore. Why are they not worried? I'm not sure.
And it's surprising that the oil price is holding up well despite, this dollar rally in the dollar index that's been happening because, in the past, the correlation was when the dollar strengthened, the oil price didn't necessarily do that well. But at a certain oil price, Eric, maybe it's $85, $90, somewhere between $85 and $100 a barrel, the oil price starts to act basically as a tax on consumer discretionary income, on consumption. People start to maybe not buy SUVs or carpool more or not drive around as much, either walk or find alternatives like that. And the other thing is, if the oil price stays high enough and the oil companies and the national oil companies are aware of this, that would incentivize more investment into renewables. So yes, there would be, at a higher oil price, there would probably be more investment into finding more oil production, but it would also incentivize the alternative energy community to go and raise capital to go invest in like advanced biofuels and other alternative energy too as well.
Well, that correlation breakdown that you're describing, where normally the U.S. dollar and oil has traded inversely, where one goes up, the other goes down, it's going to be very interesting to see how this plays out. Is there really a change in correlation to where suddenly there's a positive correlation? Or is what's going on here that oil prices are rising so rapidly that even as the dollar rises, which causes oil prices to effectively fall, it still looks like it? Well, what we're potentially on the cusp of, I just interviewed Juliet de Klerk on Macro Voices this week. Some analysts, including Juliet, think that a big move down in the dollar is coming. Well, if we're going to suddenly see the dollar index reverse to the downside, does that mean that it's just going to be an acceleration or an amplification of this rally in oil prices to where they really shoot up at that point? Or could it actually be true that there really is a change in correlation to the point where a weakening dollar would somehow weaken the oil price? I haven't seen a really conclusive analysis on either side of that. I would note something, though, from just my own research. There's another correlation that nobody's talking about that's broken down in recent weeks, and that's the time spreads in crude oil. Now, by that, I mean the difference in price between one delivery month and another. And in the past, what's always been the case is these time spreads kind of move in sympathy with one another and in sympathy with the front month oil price. So in other words, front month oil price goes up a whole lot. The long-dated futures that are several years out on the curve don't move up as much, so the spreads, the difference between 1 month and the next, goes up as the front month price goes up. And normally that happens all the way across the curve. Well, what we're seeing up until the 18th of April is things were happening kind of like you'd expect them to. As the front month price goes up, the time spreads go up. Starting on April 18th, the time spreads just to the end of 2018 started going down dramatically, even as the longer dated time spreads, the ones out in 2019 and 2020, were going up. I've never seen a breakdown of correlation where time spreads at the front of the curve are going down while time spreads at the back of the curve are going up, unless it was associated with a very specific logistic event like a pipeline going offline that's going to dramatically affect the supply in Cushing, Oklahoma in the next few months, but not later. Something like that would explain it. But that we went to near-dated spreads coming down dramatically from the 18th of April through the 14th of May, while long-dated spreads were moving up. And since the 14th of May until we're speaking on the 18th of May, what we've seen is those near-dated spreads, that's between now and the end of 2018, those are moving up. So they've reversed direction to the upside, while the longer-dated spreads have reversed direction to the downside. So we're seeing all kinds of crazy breakdowns and correlations that normally are very reliable in the oil market, and I can't find any explanation for them. So it kind of feels like a whole bunch of things are just going in different directions, and I don't have any explanation for why it's occurring.
That is very curious. Well, if a lot more supply does come online from that marginal supply, I think at some point we will have a bust, but I don't think it's anytime soon. I'd have to see evidence that a lot more marginal supply is coming online. So I don't think we're anywhere near there yet. It's going to probably be at least a year before that type of supply becomes a big concern. But the other thing that is worrisome for me, Eric, as a contrarian, is the total, record amount of speculative long oil futures contracts. So, this has been going on for a while and it's building. We have to give them credit, the hedge funds that were most of the specs, right? They did predict this move higher in oil price, but I don't know how much higher it's going to go. At some point, if the oil price does go higher, it's going to act as a tax on the real economy.
Yeah, and what we're seeing is that record net speculative length is coming off a little bit in the last few weeks. It's still huge, but it's starting to come off. They're starting to take profits up here. And the thing is, if nobody panics, if they slowly and gradually, say, hey, we've got a really nice, healthy profit, let's take it, and that speculative length comes down, then the risk comes out of the system. What I was afraid of is if this rally continued, it's just going to embolden the speculative longs even more. And they keep putting on more and more long positions, making the net length even longer than it was before. Fortunately, that's not happening. That would be the real setup for a massive surprise. And the thing you have to remember, this has gone on long enough, Jason, that a lot of these guys who are holding big speculative positions in crude oil, they've got a really big, fat, healthy profit built into their position. And, of course, everybody's trading strategy and style is a little different. But for most investors, when you've got a big profit in your position, you're much more likely to tolerate some downside and not panic and sell in a hurry. And they've got plenty of room. If they're not going to panic until they get back to their break even, a lot of them have a long way to go before we get back to their break even. I don't think they would wait that long, but I think it would take a shock at this point, especially with so much geopolitical tension in the system that is creating upside pressure. I think it would take some kind of shock. Now, I'm not saying that shock can't happen. Certainly, if President Trump announced, "Hey, I've brokered a deal between Israel and Iran, and we're going to have a better Iran nuclear deal that is more beneficial that I can approve of. Everybody's going to sign it, and everything's going to be hunky dory, and we're not going to have any sanctions against European companies, and everything's going to be great again." That's frankly very, very unlikely to occur in this political environment. If something like that happened, I think it could create a panic unwind of that big speculative long. But I think it would take something pretty big in order to start the avalanche, so to speak, just because the people holding those positions already have so much profit built into them.
And I think also it would depend, if they unwind those positions, on how well the fund manager is doing managing the rest of their portfolio. So if that's the only winning trade or the biggest trade, they're going to want to take that profit and go to their investors in their quarterly or monthly newsletter and say, look, we made a huge profit in oil, we're selling now, and go and reinvest the money into other more undervalued trades. It just depends on how the rest of the portfolio is doing. I would say that's definitely a factor.
Well, and I think it also has a lot to do with the perception. If people feel like, okay, we're getting a little pullback in oil prices, hey, that's just part of the way markets move. On the other hand, if it's an event that's driving it, if there was some kind of treaty announced or some deal that was made to de-escalate the Iran-Israel situation dramatically overnight, I think that could be where everybody says, uh-oh, the game has changed. Let's get out of our long positions in crude oil. And that could start the avalanche that you're talking about. So I think it is market conditions as well as, you say, with what the portfolio managers are doing in their other investments.
Last question on the oil market. So do you think the petro-yuan contract is having any type of impact on the oil markets yet? And do you think that China really wants to go back petro-yuan and the world reserve currency?
Well, I don't know what China's real intention is. I would say that this contract has gotten more volume, more trading volume, and I think that's the measure. You talk to different people are going to have personal opinions about whether or not this is important or not. How do you arbitrate who's right and who's wrong? At the end of the day, I think it's the market share and trading volume on the petro-yuan contract that really decides that. To my surprise, it's seen some real volume. I thought it was going to be a sleeper, and it's seen some significant volume. It's not the same as Brent or WTI. It's nowhere close to that. It doesn't trade as many hours a day. It's in a different category. But a lot of people thought that this contract was really going to be just a symbolic gesture that would never get any real traction in the market, and it is getting some traction in the market. So I think that's a development that surprises me and I think works to China's benefit. In my opinion, the gold-backed aspect of this is mostly marketing. There's really nothing that guarantees exchange of oil at a fixed rate to gold. All that's really saying is, look, you trade your oil in yuan. Well, the immediate objection of any international investor is, hey, I don't want to trade anything in yuan because my profits are going to be stuck in yuan and I won't be able to get my profit out of China. And the answer to that is, well, look, we're giving you the ability to buy gold with it and take delivery of the gold, and that's your way. They're basically just showing them a way that was already there. If there was nothing in this contract related to gold and people just figured out on their own, hey, we could take our yuan-based profits on the oil contract and buy gold in the Shanghai Gold Exchange, that would be a way to get our effective value out of China. You've accomplished the same thing. So I think the gold backing is really just the exchange's way of explaining to investors, here's the path through which you can get your profits out of China if you want to, despite the capital controls that exist on the onshore yuan. So I don't think there's a whole lot more to the gold backing than that, but it is a significant provision of it. What I think is going to be most interesting is at some point, as a result of this whole Iran situation, there's a lot of discussion in Europe about finding ways to fight back against the Trump administration because a lot of European politicians don't approve of the U.S. kind of unilaterally killing the Iran nuclear deal. So will European countries negotiate to, the Brent contract currently is settled in priced and settled in dollars. But could there be some provision where European companies are going to say, hey, we're going to somehow make, just as China has taken their yuan-based oil contract and said, well, it's gold convertible, guys, so there's your avenue. Are European politicians and governments going to say, hey, this Brent contract is priced in U.S. dollars, but it's euro convertible. We could still do settlements in euros if we wanted to. We could pay Iran for their oil in euros and bypass the dollar. Will Europeans start to also try to bypass the dollar the way China is trying to bypass the dollar? And if they did that, would it really be their intention to bypass the dollar, or would that just be a negotiating chip that they use to get President Trump to back down and change his policy? It remains to be seen, but I think that's going to be a very interesting facet of this as well.
Yeah, the alternative media and the gold community was touting this petro-yuan contract as, it's going to crash the dollar very quickly. And I was like, well, the petro-yuan is going to probably take years for the market to trust for volumes to rise on this contract, for it to be significant at all. So I just don't consider it very significant now. Now, if the volumes do increase a lot, like you said, at some point in the future, I'll admit I'm wrong and I'll change my mind. But right now, I don't think it's a viable threat or alternative to any of the major oil markets right now. But in terms of the dollar, I think is in a long-term secular bear market. So it's had rallies. I think right now the dollar is having a bear market rally. I did some short videos on this in the last month or two. And so, the dollar index at 88 support levels, it almost broke 88. It could have potentially crashed to 79 on the dollar index support levels. But, now it's rallied. It's over 93 when we're talking. And there's really, in terms of you're looking at the dollar index on the charts, there's really not a lot of overhead support levels until it gets to 100 or 102. And at that levels, if the dollar gets to there or higher, if it breaks that overhead resistance, it could cause a lot of problems in the global economy for emerging markets and other, foreign corporations that have overborrowed in dollar-denominated debt, right?
It certainly could, but unfortunately, I think that it probably has to get there before anybody does anything about it. In other words, if we were at a dollar index at 105 instead of 93, at that point, I think there would be a lot of pressure on the United States from those emerging market governments to say, hey, we're going to have a global financial crisis if you guys don't do something to arrest the rise of the dollar here. At current levels, that's not going to be a factor. And I just interviewed Juliet de Klerk, who's dollar bearish as well, and I'm also dollar bearish in the very long term. There's no doubt in my mind mind that in the long run, the U.S. dollar loses its hegemony over the financial system globally. It loses its reserve currency status. Doesn't necessarily mean in this day and age that something else, like the yuan, becomes the de facto reserve currency. We don't really need a single reserve currency. You know, back 100 years ago, you had to have a single reserve currency because if you were paying for goods in different currencies, you literally, the only way you could get some more of that currency that you're going to pay for things with was to send a ship across the ocean full of gold and trade it for some currency and bring it back to your country. It took months and months. In an age where we can do international forex transactions at the click of a mouse in a few milliseconds, you don't really need to have a global reserve currency, a single global reserve currency, the way you used to. So I think the dollar will just lose hegemony over time. But that's the long run. In the short run, over the next year or two, I think there's plenty of room for this dollar rally to continue. And it's a question of time frames. You know, if you're talking very long term, I agree it's a counter trend rally. I think that the long-term trend is going to be down for the dollar. But when I say counter trend rally, I mean like for a year or more, I think you could see the dollar continue to rise. Now, Juliet de Klerk, who's a much more experienced analyst than I am, has the opposite view. And she just gave me a fantastic interview this week with a bunch of graphs and charts saying why she thinks the dollar is imminently about to reverse to the downside. So we'll see what happens.
So basically, in 2018, switching gears here, we've had a lot of asset price volatility, basically what traders would call chop. So some days the stock market's up 1%, some days it's down 1%, some days it's up 2%, some days it's down 2%. And yet the VIX, the VIX is back down after that February spike, which we talked about in our last interview 2 months ago, that big February spike. The VIX is back down below 14 again. And I interviewed a trader and he was talking about the tracking error with a lot of these VIX ETFs, that there's huge problems with them, that if you're a retail or even a professional investor, you should not be buying long positions on these VIX ETFs. So what's your opinion then on volatility going forward? And people should avoid the VIX ETFs, right?
Yeah, I mean, the VIX ETFs have been wrought with problems from the beginning. As far as volatility, and I'll expand your question a little bit just to say equity markets in general, I've changed my view in the last few weeks, and the reason is the breakout in Treasury yields beyond 305 on the 10-year, which was a really key technical level. We broke as far as 3.11 earlier this week. We're back down as we're speaking today on the 18th. We're back down to about 3.06 or 07. So, that technical analysis tells us you tend to break out, go back down, and retest. If this plays out as a typical retest, in other words, we come back down and just kiss that 305 level, which was the key level, and then move up again from there past 3.11 or whatever the previous high was from a couple days ago, that really confirms the upside breakout in yields. And I'm convinced, Jason, that there is a number on the 10-year Treasury that just breaks the stock market, where people say, oh my gosh, we've really got a problem in equities here as a result of runaway Treasury yields. What's that number? Nobody knows for sure. The market's going to tell us. Some people thought as soon as we broke 305, which we just did the other day, that equity markets were going to crash. Well, they haven't crashed yet. I talked to Harley Bassman a few weeks ago. He thinks 350, 3.5 is the magic number. What I found very interesting is I talked to a lot of really smart people. They all disagree on exactly what the number is, but almost all of them agree. There's a number that we're probably going to get to at some point where it's Treasury yields that crash the equity market. I don't know what that number is, but I watch what's going on with Treasury yields to tell me what could happen next. And what I see is breakout beyond 305. I don't know what could happen. I'm surprised we didn't get more downside as a result of that. But certainly it was that breakout that arrested. I mean, we had a pretty good rally going. It was Tuesday morning of this week, Tuesday, the 14th of okay, well, all right. I don't have the right month in front of me, Jason. My apologies. Tuesday of this past week that ended on Friday the 18th, whatever that works out to, 14th, 15th. That's when the Treasury yield broke out, and that's when the rally in the equity market stopped. Now, it hasn't gone down dramatically, equities so far, but I think that if the Treasury yield continues to move to the upside, that it very well could. And so I'm kind of in a different view now, where I thought we might get back to new all-time highs, and I've thought for a long time that we're in a topping pattern on equities, but I thought maybe we'd at least get a retest of the previous high, if not new all-time highs. Now I think it's more likely it's a question of how far we can go with a summer rally before that rally fails and we move to new lows.
And I interviewed Dr. Mark Faber last week, and he thinks that number that you were talking about with the experts, that they agree a certain specific number on the 10-year will crack the stock market. Mark Faber thinks it's 4%. But, when you look at some of the factors going into it, that the Trump administration is going to be running budget deficits of over $1 trillion. There's a potential trade war still with China in the near future. And the Federal Reserve is potentially going to be reducing its balance sheet by more than $100 billion because the quantitative tightening, which supposedly ramps up in October, is supposed to increase to $50 billion per month. Now, it's not going to probably happen right away that there's huge sell-offs in asset prices, but if the Fed is actually serious about it, and it's more than just talk, if we're looking at hundreds of billions of dollars in asset sales by the Federal Reserve, who's going to be the buyers? So I don't think at the yields that we are at now that there will be a lot of buyers. So Mark Faber said last week he thinks that there will be buyers of these assets the Fed wants to sell, but it will have to be at a higher interest rate. Do you think then that means that there's a a bear market in bonds now for sure with the rising yields?
Yeah, the only potential salvation for the bond bulls would be if this breakout past 305 turns out to be a false breakout. So far, what we've seen is we broke 305. We got to, I think, 311 was the high print. We're at 306 right now on Friday afternoon. If we come back down, touch that key level at 305 again, and then move from there higher past 311, that, I think, is your confirmation that the big bond bear market is on. And a lot of people have been saying for more than a year that the secular bear market in bonds is on, but we haven't really seen technical confirmation of that. The other one that Julian Brigden pointed out to me, I think is a very telling number, is the 100-month moving average on the 30-year Treasury. We have not seen a closing monthly print above the 100-month moving average on the 30-year Treasury, on the yield that is, since the early 1980s. Right now, that number is around 3.25 is the moving average, and the yield is at 3.20. So we're 5 basis points away from a breakout on the 30-year long bond that would represent a first-time event in 30 plus years. So there is maybe a couple of confirmation signals left that we haven't hit quite yet, but I think the big bond bear market is on, and I think the biggest risk that it poses, which not everybody's talking about, is I think you could see both bonds and equities selling off at the same time. And what that would do is it's a break in correlations with what everybody assumes is a safety hedge. They assume that their bonds are a hedge against volatility in the equity markets. When they lose money on their stocks, they're going to make it back because bonds are going to go up. Well, if bonds and stocks are selling off at the same time in unison, it really gives all of the people running what's known as the risk parity strategy, where you use levered up bonds in order to mitigate your volatility risk in equities. They have no option or choice at that point but to say, okay, the whole basis of our strategy has been this inverse correlation between stock prices and bond prices. That correlation has broken down. We have no choice but to unwind our positions that are in this risk parity strategy. Well, that's like most of institutional finance is in some flavor or another of this risk parity strategy. If it all had to be unwound, and this is something Harley Bassman pointed out to me, you don't need a panic. All you need is for people to do their jobs, for institutional portfolio managers to say, hey, we've got a large position on that's based on the assumption that a correlation is going to continue to exist. We can demonstrably see that correlation no longer exists. It's time to unwind those positions. If everybody is selling all their bonds and all their stocks at the same time, you got bonds and stocks going down at the same time. What's the result of that? All of institutional finance is forced to sell bonds and sell stocks. Well, needless to say, they're both going to keep going down if everybody is selling them. So you get into this self-reinforcing vicious cycle if you see an unwind of the risk parity strategy. And I think it could create a financial crisis much worse than 2008.
That sounds like that scenario would be good for cash, US dollars, and also for gold. People would potentially go to both of those as like some type of temporary safe haven. But the US's national debt is over $21 trillion. And so basically for every 1% increase in interest rates, the US government is going to be paying $210 billion. So if interest rates do keep increasing, that's going to blow a hole in the government, finances, to where even more of the government's budget is going to go to interest payments. So the government's going to run even larger. It's becoming that vicious cycle. So for a long time, there was a lot of experts. Jim Rogers and Doug Casey, who I think are both brilliant, but they were talking about the U.S. national debt problems like 20, 30 years ago. And so we weren't at a level back then where interest payments were a huge concern for the U.S. federal government. But now at this point, if interest rates rise another 2 or 3%, that's $400 billion or $600 billion increase in interest payments. So now it's becoming concerning with the compounding of those the national debt and interest rates then.
Well, and the thing you have to understand is the reason that really smart people like Jim Rogers were talking about this 20 years ago is that 20 years ago there was still time to fix it. There's not anymore. Even if everybody woke up tomorrow and said, oh my God, $21 trillion, and we've got what could be a secular bond bear market, that means increasing interest rates. And you know what else? It's not just increasing interest rates, but the average maturity of the government's debt has come down dramatically. It used to be that a whole lot of stuff was financed with 30-year bonds. So the government, could wait 30 years before they had to worry about rolling that debt forward. The average maturity is so much shorter now that if you see a secular rise in interest rates, it's going to dramatically increase the U.S. government's cost of borrowing. And it's a perfect storm, Jason, because it's coming at a time when other geopolitical forces are favoring a move away from the U.S. Treasury as the world's favorite safe haven asset and favorite central bank reserve asset. So if suddenly what you have is the government is screwed, they're really in trouble, and they have to sell a lot of U.S. Treasuries in order to finance their operations because they're going to go broke otherwise. And it happens to come at a time when the rest of the world is saying, hey, we don't think we really want to buy any more U.S. Treasuries. You get a U.S. fiscal crisis, and it's something that I don't know how they could fix it. And I've been really surprised. I talked to so many people, smart people, and I asked them, at what rate of interest, at what 10-year Treasury yield do we have to get to before the U.S. government basically goes bankrupt? And they always say the same thing. Oh, you never have to worry about that, Eric, because they can print more money. Well, wait a minute. If they start to resort to acts of desperation, like outright debt monetization, printing money just for the sake of buying their own debt, at that point, you're sending a signal that's going to cause the rest of the world to get even more concerned and sell that treasury debt at the same time. So there's another self-reinforcing vicious cycle that can erupt if you start to do reckless things in order to control this. So I think when you get to the point where the U.S. government is unable to finance its operations because it can't roll its debt forward at an affordable price. A lot of people think that a doubling of Treasury yields is very possible from here in the next 2 or 3 years. Well, that means a doubling of the U.S. government's cost of borrowing, and that's a huge part of their operating budget. You can't. The only way you could do that is double everybody's taxes in order to, not have to borrow even more. And what are you going to do if you have to borrow even more? Nobody wants to buy it.
So I don't think they'll increase taxes that much, at least direct taxes. So the inflation tax is normally the way that the governments prefer because it's a stealth tax and most people don't even notice for a while. But I've thought about that as well. And, eventually I don't know exactly when, but I think the Federal Reserve is going to reverse their quantitative tightening and they're going to have to go back to QE because there's not going to be the demand for the private sector to go and buy more than $1.8 trillion in new debt that the Treasury is going to have to sell, including the amount that the $600 billion in the next year that the Federal Reserve supposedly wants to sell in assets. So either interest rates increase and there's more buyers that way. The other scenario is, and this would be un-American as well, but you've seen this kind of in Japan, is if the U.S. government starts forcing people in their retirement accounts for, I don't know, they call it for national security, that they have to put 1 or 2% mandatory of all your assets into treasuries. So you're doing it kind of like, during a war scenario where you're buying war bonds or infrastructure bonds. So there might be a scenario like that where they basically force everyone in their retirement accounts, IRAs, 401ks, or if they're a government employee or teacher, to go and buy mandatory 1 or 2% total assets in government bonds, and they have to hold them. And then the government could just potentially discuss what Japan is discussing on doing and just keep inflating away the bonds by monetizing the debt and increasing the total years of the bonds. I think Japan's even floated the idea of a 100-year bond, but they haven't done it yet, but they've at least put the trial balloon out there. So I want to transition now to something that two very smart people who I respect a lot discussed on a recent podcast for Real Vision TV. So episode number 65 of Real Vision TV's Adventures in Finance podcast, Grant Williams and Raoul Pal discussed that basically a lot of markets are at record extremes. So we have a record US dollar short position, record speculative longs in oil futures contracts, almost record speculative longs in copper futures contracts, biggest ever short position in bonds on the 5-year, 10-year, and euro dollar futures, plus a massive leverage short volatility trade on not just the stocks that you and Christopher Cole have talked about, that $1.5 trillion trade, the leverage short vol trade in the stock market, but there's also a leverage short volatility trade in commodities, bonds, and currencies. So what do you think this means for a lot of different markets going forward, that the ability, that volatility, an increase in volatility will blow something up then?
Oh, I think it's a ticking time bomb. It's a powder keg. Insert your favorite metaphor. There's maybe one place I would qualify it. I think that the speculative short positioning in US Treasury bond futures is a little bit overhyped, simply from the standpoint that, in something like crude oil, that massive speculative long positioning in crude oil, that's real because that's where all the trading occurs in crude oil, is in the futures contract. Now, in treasuries, it's the treasuries themselves where most of the volume occurs. Treasury futures are a much smaller market than the treasuries themselves. So it's not like the entire treasury market has a record speculation. It's the treasury futures market where that speculation exists, and it doesn't have as big. It's still very real, but it doesn't have as potentially debilitating an effect as something like the copper futures or the oil futures, where the futures contract is the whole market. So I think treasuries has been a little bit exaggerated. Everything else, though, these are all the types of things that get you into a 1929-like situation. Everything is so good. Everybody is so complacent. They don't think it's possible for things to go so wrong that all of this stuff blows up at once. And as Grant and Raoul talked about in that podcast episode, well, the market has a way when everybody thinks something can't happen of getting it to happen. And I think that what we have to be concerned about, and I think probably, in my opinion, the trigger that really lights the fuse on this powder keg is a return of secular inflation. And the reason I say that is, almost no matter what the problem is, if you can get away with conjuring money out of thin air through quantitative easing, you can solve almost any problem by throwing money at it. And when you've got a printing press to print as much money as you want to, you can solve a lot of problems. When your printing press gets taken away from you, and the mechanism for that is if you've got runaway inflation, then creating more money supply exacerbates the inflation problem, and it becomes a vicious cycle. It's self-reinforcing. When you get to secular inflation, runaway inflation, that's where you're taking the keys to the printing press away from the central bankers. And at that point, they won't be able to bail things out. And so simultaneously, first, they're not bailing the world out, but it's more importantly, the market comes to the sudden realization of, oh my gosh, the Bernanke put, the Yellen put, whatever you want to call it, that assumption that if things get really tough, the central banks will bail us out. It's not going to work anymore. We're on our own. We're out here by ourselves in the middle of the ocean. There is no Coast Guard. That's when everybody panics and you see ungraceful unwinds of those massive, massive positions in all of these things. And I think it could be absolutely astronomical. And to go back to your earlier point about pensions and so forth, it can get worse than just requiring somebody to put treasuries into their account. The government can announce, hey, after what happened with 2008 Wall Street, these Wall Street guys can't be trusted. We have to nationalize all of the pension systems. All the 401ks will be managed by the government, and they'll all be, in treasuries and equities that are selected by the government or something crazy like that. Most people would fall for that. And if things get desperate enough, that's what they'll be forced to do.
Everything is just way over leveraged, and yet it continues. I could name, and I'm sure you could join in with this, we could spend the next hour naming a list of over 40 different credit bubbles or asset bubbles that have been way over leveraged. So there's record, stock margin debt, there's record share buybacks with debt. US corporations are drastically over leveraged right now. The guy who set up the Big Short trade, the former investment banker at Deutsche Bank, he said that he thinks the next big bubble is the corporate debt bubble. I can't remember if it's the IMF or the Bank of International Settlements, but one of them said that 20% of all global corporations are basically zombie corporations, and they need lower interest rates to keep rolling over their corporate debt, and they can't pay back the principal, but they're only paying off the interest payments, and they're just rolling over debt, continuing that way to keep their doors open. They're just rolling over debt and increasing the size of the principal of their debt. We could talk about the Canadian housing bubble and the increase in debt there. There's just so many different bubbles right now, and yet everything just continues. CNBC, everything's hunky-dory.
Well, you've got to realize, too, that, people always, that what they do is what they are personally incented to do, what's best for their bottom line in the short run. And what we did after 2008, we didn't actually fix any of the causal problems. The problem was too much debt, both public and private. What do? We created more debt, but we did it in a way that was throwing money at the system and calming everything down. But in the process, as you say, and it's important, I think, for your listeners to understand this, we created personal incentives for corporate executives. We said, look, what you have the ability to do, thanks to easy money policy from the Federal Reserve, is your corporation can borrow money recklessly that it will not be able to afford to pay back someday. And you're a smart guy. Someday, as interest rates go up, it will be unable to pay that money back, and it could cause the bankruptcy of your company. But if you do that now today, it's going to dramatically boost your stock price so that you, Joe CEO, get a massive bonus, millions and millions of dollars that you bank and buy gold with because you're no dummy. And sometime, not on your watch, but when the next guy is at the helm, this is all going to blow up in his face because the system was set up with incentives that allow you, Joe CEO, to recklessly borrow money that is going to be the end of your company someday, and you can get a huge, huge bonus for doing that. And by the way, the Wall Street bankers that are financing these junk bond deals in order to finance share repurchases, they're not stupid. They know what this will all lead to, but they're making huge commissions. They're making huge fees getting Joe CEO to basically sell his company's shareholders in the very long run out completely and get himself a huge bonus here and now. He will have cashed out of all of his stock options before this all blows up in everybody's face. He's smart enough to know what's coming because he created the problem, and he was paid very handsomely for setting the system up, as were all of his other fellow CEOs, setting the system up to eventually fail dramatically. And it's a lack of oversight. The people who understand this stuff and how it really works, they're all the guys that are making a buck on it by getting fees for putting these deals together. Or they're the CEOs. The government that's responsible for overseeing all this doesn't understand how it works.
It's all myopic rent-seeking. It's all short-term oriented. So they're not thinking about the long-term and making sure that the company is better off in the long term with new products and services, investing in research and development, creating jobs. In the past, in the stock market, for the share price to go up, the company used to have to grow revenues and invest and create new products and services, and that's not the case anymore. The stock price actually for a lot of companies goes up when they either, like you said, use share buybacks with debt, and they artificially engineer earnings higher by reducing the share count, or when they close down factories and fire employees. That means the share price goes up too, because the stock market says, okay, they're cutting costs. So that's good for the bottom line.
And can you imagine, Jason, the way the way that we compensate corporate CEOs is with stock. And the idea is if the value of the stock goes up, they get that benefit. That just creates this short-term focus. Now, the value of any stock, in theory, it's something that can be calculated as the value of future cash flows, the value of the future dividends or earnings of that company. What if instead of giving CEOs stock, you gave them no stock? You just gave them access for the rest of their lives to that dividend cash flow, the profitability of the company in the very long term. They don't have the ability to cash out in the short term and let it blow up on somebody else's watch. Their actions today are going to affect what they get out of that company 25, 30 years into the future. I think that would change their behavior quite a bit, but unfortunately our compensation systems don't work that way.
Yeah, I think it's going to get worse, unfortunately, in the short term before it gets better. There is a lot of problems with that, like you said. So for the last couple of minutes of the interview, let's talk about Bitcoin and cryptocurrencies. So you did a very interesting discussion with Tur Demeester. I'll put links in the info section for our listeners. It's 2 parts. It's a long, in-depth discussion. It's not, name calling in a debate. Like some of the things out there, but the cryptocurrencies have been having a big rally for the last month or two, and the market caps of all the cryptocurrencies is almost to $400 billion again. But you think there are serious problems with Bitcoin? You called Bitcoin the plane that's no longer the first plane that was invented, that was the pioneer in the market, but it's no longer relevant. So why do you think Bitcoin's not going to survive?
Well, I liken Bitcoin to the Wright Flyer, the first airplane ever flown. As you say, it's so important to history. Bitcoin did something with its blockchain distributed ledger, which basically created a truly independent, no one party is in charge of the ledger. It's distributed across a network in a way where nobody can hack it. And it's really some brilliant breakthroughs in computer science that happened. It'll be remembered forever. But you go to the airport today, you don't see many Wright Flyers parked on the ramp ready to carry passengers because there's been advances since then. And everything in the current blockchain-based cryptocurrency, and this is true of Ethereum and Bitcoin and all the other ones that are based on a blockchain, the way that it works is something called a proof of work algorithm, which basically means the way you prevent the hackers from hacking the system is to make everybody's participation in the network super expensive in terms of computing cycles. They waste a lot of energy. This is the reason that Bitcoin consumes so much electricity. They waste a huge amount of energy doing completely unnecessary math problems just to prove that they're not spoofing the network. That's the only purpose this solves. Now, as soon as somebody comes up with a way, and by the way, they've already done it in what are called permissioned networks, not a completely independent network, but one that has some limited extent of central authority in it. They've already solved this problem, and it will get eventually a completely independent version that doesn't require this proof of work algorithm that does nothing but waste energy and waste computing cycles. And more importantly, though, I think governments are eventually, I think, going to co-opt or usurp digital currency. And I use the word digital currency, not necessarily cryptocurrency. Cryptocurrency, like Bitcoin, is designed to be impenetrable by governments. It's designed from the get-go to be something that governments cannot tamper with. I think that as soon as governments are able to engineer their own digital currencies with the exact opposite objectives, that governments can control everything, that they can audit every transaction, that they have the ability to seize wallets and tax transactions and, do all the things that Bitcoin is designed to prevent. Once the government has the technology to do the opposite of what Bitcoin is designed to do, I think they will outlaw cryptocurrencies. And, of course, the Bitcoin buffs will tell you, oh, well, it's impossible. You can't outlaw it. That's nonsense. You can certainly, it's true that the Bitcoin network, it would be difficult to prevent a network from existing on the internet. But the ability to transact, to exchange cryptocurrency for fiat currency, that could very easily be outlawed, and they could enforce that. So Bitcoin could be relegated to essentially a useless set of poker chips that, monopoly money that gets traded back and forth, but cannot be converted into fiat currency, because converting it into fiat currency has been outlawed, and it's very easy for them through the banking system to plug those holes. So that, of course, somebody would exchange it for fiat currency, but they would be a criminal by definition at that point. So only the mafia is going to exchange your cryptocurrency. At that point, very, very few people are going to use it. So I think that the first generation of cryptocurrencies, unfortunately, will be outlawed and replaced by government-issued, not necessarily cryptocurrency, but digital currency that has all the opposite characteristics. Everything is traceable. Everything is auditable. The government, it's basically the Big Brother scenario, and that's why I say the digital currency of the future is not Bitcoin. It's something I call the Orwell, named after George Orwell, and it's a digital currency that has all the opposite characteristics of Bitcoin. And just to be clear, I don't think that's good for the world. I think the best thing that could happen would be for me to be proven dead wrong, Tour de Meester to be proven exactly right. Bitcoin takes over, becomes the center of the world, and somehow grows to overcome the limitations of its proof of work algorithm, gets better, and it's the thing, and the overreach of government into our lives is contained and prevented by this cryptocurrency idea. I think that's great. I'm all for it. So now your listeners don't hate me personally as much as they did a minute ago. Unfortunately, I don't think it's going to go down that way. I think the government's going to win. They've got the handcuffs and the guns in the courts, and it would be very, very easy if they just announce Bitcoin is the tool of criminals, and it's used to finance terrorism. In order to fight terrorism, we have to outlaw Bitcoin. The masses would fall for that. Of course, that's nonsense, but most people would fall for it, and the cryptocurrency crowd would be upset, but they wouldn't have any choice. And I think there's a very real risk that cryptocurrencies across the board will crash someday when it becomes clear that the government is eventually going to outlaw it. And again, you can't outlaw the existence of the network, but you can very easily outlaw the conversion of digital currency or cryptocurrency into fiat currency. And as soon as you've done that, it's going to lose most of its practical value.
Well, we've had tons of crashes in the cryptocurrency market. Bitcoin has crashed more than 60%, I think, over 7 times in its 8-year history. So there's been a lot of crashes, but there's actually a ton of trading in the cryptocurrencies. A lot of it, most people are surprised to learn about this, is actually in Asia. So it's in Japan and South Korea. There's a ton of gambling on it. So there's people who don't know anything about stocks, anything about other investing markets, who are trading cryptos like crazy, trying to get rich quick off of it. So, I think there is going to be a lot of innovation in blockchain and these different cryptocurrencies, some of these altcoins, but we haven't had a lot of practical uses for some of the coins yet. But I think, in the next 10 years, there is going to be more adoption of it. I know a lot of large corporations. I've interviewed Perianne Boring from the Chamber of Digital Commerce, and I've seen vice presidents from Microsoft, Cisco, IBM, and others talk about this. They're spending a lot of money on research and development, testing out how to use blockchain, but they're going to be testing out for years before they actually implement it. But one thing you brought up that I think is important, a lot of people think that Bitcoin is anonymous. It's not anonymous. So there's the ability there. It's a database. It's stored. All that information is stored. The transactions are stored. So with IP addresses. So you can't mask that transaction. It's not anonymous like people think. Now, obviously, there's other cryptocurrencies that are working on this like Monero, but Bitcoin itself is not fully anonymous. So what worries me, and I think you touched on this, is that governments, and I'm a libertarian, I know you're a libertarian, is that governments could potentially, in a totalitarian scenario, track and tax every single transaction. We've heard government economists like Ken Rogoff. Rogoff put out a book about this, I think, November 2016, called The Curse of Cash. Rogoff wants to ban $100 bills and, higher currency. I think he even talked about $50 or $20 bills he wants banned. So there's Keynesian government economists that send out research to central bankers and politicians, and they want cash banned, and they're still talking about negative interest rates. So thankfully, we haven't had this implemented yet in the real world, but there's still a lot of highly paid, in my opinion, overpaid academics still talking about, we need to go to a cashless society to track and tax every transaction, and we need to implement negative interest rates so we get people to spend the money how we want them to spend the money.
Well, this is something I think is really, really important for people. You're not going to like this, folks, but it's really important to take to heart. I'm a libertarian, Jason. You're a libertarian. Guess what? We're in a really small minority. If you listen to what Ken Rogoff says, which is we need to ban cash so that everything is traceable, trackable. You can have negative interest rates, which can be used as a monetary policy tool to force people to not practice sound, intelligent, disciplined, personal, saving money.
It's a disincentive. Yeah.
If we need to give the economy a boost, we basically prevent people from being responsible and force them to spend recklessly. Otherwise, they're going to lose money, and that's a way to boost the economy. These guys really believe that is smart. They think it's a good idea. There's more of them than there are of us, and it sucks. I don't like it either, but there's more of them than there are of us, and furthermore, the direction politically, if you look at what's going on in the world, the millennial generation is ready to embrace socialism, which was unheard of when I was growing up. And I think in a lot of ways, they don't really fully understand what the limitations and what the history has taught us about the failings of socialism. I saw somebody on Twitter said there should be a rule, like a reality show or something. If you really think socialism is the thing, you should be flown for some reality show to a country which has been socialist ruled for the last 50 years and live there for a year, and then the exit interview is, or do you still think socialism is the right system on the way out? But they're not doing that research. They're sick of the status quo. They want to change, and they would welcome a change to socialism. So the general political mood is moving further and further away from individual rights, from financial privacy. These are things that are increasingly being labeled as, the only people who would believe in libertarian values, they must be hiding something. They must be criminals. They must be terrorists. They must be people trying to finance terrorists. It's a bunch of BS, frankly, Jason, but there's more people who believe that BS than there are of us. And we've just got to accept that that's the world that we live in. And I think something that a lot of people don't recognize is the only reason that Bitcoin is sort of kind of partially anonymous. I mean, it's never been anonymous. People say it's pseudonymous, meaning that you've got a wallet that has a number and nobody has your name. Well, the thing is, the government hasn't built the systems it needs to build to track it all. But for any cryptocurrency, if you're going to have exchanges that convert them into fiat currency, the government can build a monitoring system which tracks who's getting money in and out of cryptocurrency, and they can deduce from there. They might not know exactly how many Bitcoins you've got, but they know how many you converted into dollars. And if they can track all that stuff and track your IP address and all that, they can get it to the point where they eliminate, all this anonymity of Bitcoin that supposedly, if you read the white paper, it's all something that if you're careful about how you do it, you can protect your anonymity. That's only true if you never convert your Bitcoins into dollars. As soon as you convert them into dollars, it's that transaction that the government can monitor or trace at some point. So none of it's ever going to be completely anonymous, and it won't take long for the government to build those systems to do that kind of tracking. So, forget about the idea that you're going to have anonymous money that the government doesn't know about. They are a few steps behind right now. So there may be a temporary condition where that's partially true, but I'll tell you something. They track all the traffic on the internet. So I don't think they're just going to get to the point someday where, okay, starting today, the government can track everything going forward. It's going to be starting today, probably a few years into the future, we can track everything going back to 2008, to the beginning of Bitcoin, and we can figure out exactly what's happened ever since then because we've got all the transaction data going back that far, and we can, catch everybody who didn't pay their taxes and so forth. I think that day is coming. So, I think that anything you're seeing right now is a stay of execution. It's not actual financial liberty. What you need is a public mindset that says we, the people, should vote for laws that require our financial freedom. And the government has no business looking into our lives and looking into our bank accounts and knowing how many bitcoins we have. That should be illegal, and any government employee caught doing it should go to jail. Well, guess what? There's not enough people who think that way. We are in a very, very small minority, and we've got to accept that, unfortunately, the people around us don't see the world the way we do.
Amen. And I would add that we live in a world now of brainwashing, propaganda, and fake news, where a lot of people, especially my parents, they don't want to hear any of the things we talked about in this interview. They just care that, okay, my housing price hasn't crashed yet, so things must be good because housing prices are doing well again and the stock market's up. Not that there's a lot of problems beneath the surface with all the margin debt and all the corporate debt and all those problems that were used to raise the stock prices back, and all the increases in central bank balance sheets, which is really, death defying. So people don't want to hear this right now. They don't want to hear the truth. They just want to see that a lot of major Americans don't want to hear the truth about these things, unfortunately. But, there's just so much corruption and lies and propaganda coming out of Washington, D.C. and also Wall Street, but mostly Washington, D.C., which is where I've lived now for almost 20 years. And, you brought up the Iran deal. Last thing before I let you go, man. The Iran deal, the whole thing, it was just a payoff. It was, there was tons of cash that was not announced to the public. There was actually no need to pay Iran in cash. It could have been done with a wire transfer. This was all payoffs under the table to the politicians and bureaucrats in the Obama administration who orchestrated this deal. And the other thing is, and I've heard this from multiple lawyers, experts, there was no signed agreement. So if the agreement had been signed, that it was that bad, there would have been, documented proof that people would have eventually went to prison on. So this Iran deal was being implemented on an unsigned agreement. So this thing stinks to high heaven. There's, we can name all the different scandals coming out of DC, but, it's not just the Obama administration. It's been getting worse and worse, like I said, for decades now here in DC. And I think a lot of those problems, Eric, started in 1971, because once the last vestiges of the gold standard were off, the governments could literally figure out new ways to create almost unlimited amounts of money and credit out of thin air. And that's why we've had, these asset price rallies since 2008, because in my opinion, these global central banks, and there's 5 or 6 of them, have created tens of trillions, not 21 trillion like Nomi Prinz is saying. That's the low conservative number. The central banks created that much in basically less than a year during the 2008 and 9. The major crisis window. But since then, they've actually created, in 2017 alone, Eric, more QE was done in 2017 than those couple years in 2008, 9, 10 combined, basically. The official stated numbers of the central banks, not the currency swaps and the other things. So the amount of money and credit that's been created out of thin air to create this false narrative, along with all the other corruption, it's just, I don't know when it's going to end, but it's not going to end well.
Well, and if you look at history, unfortunately, Jason, people like you and I and your listeners who choose to take an interest in where the really big risks are and the things that could cause major disruptions to society, there's always been, for every big, big bad thing that's ever happened in the world, there was always a small group of people who saw it coming and were ignored by everyone and oftentimes ridiculed by everyone. Remember the Space Shuttle Challenger disaster? I think that was 87. There was an engineer who predicted exactly what's going to happen. He kept saying, it's the O-rings. I've inspected these O-rings, scorched O-rings. It's going to lead to a disaster. He knew it. He saw it coming. And he didn't have a PhD. They wouldn't listen to him. The PhDs had, math equations that said it was safe. He says, I don't know enough about math. What I know is I saw with my own 2 hands and my own 2 eyes. The thing is burnt to shit. When I inspected it, it's not supposed to be that way. Something's wrong here. And they wouldn't listen to him. And, look what happened. We're going to have that moment, Jason, where unfortunately, just like that guy, he didn't feel good when he was proven right. He felt like, oh, my God, I didn't do enough. And he did everything he possibly could, but he probably felt like, oh, my God, I've failed the world by not trying hard enough to make a big enough stink about this. It doesn't matter how big of a stink you and I make. Unfortunately, your podcast, I don't know what your listener count is, but it's not 500 million, which is what it needs to be in terms of people paying attention to this kind of issue to make a difference in the political system. And, until we And eventually, this kind of thing maybe will make it into a history book. Somebody will notice that you were paying attention to this, Jason, years before it all blew up. But a lot of us have been paying attention to it for years, and most people just think we're crackpots. I don't think that's going to change. And what history teaches us is people like us get viewed as crackpots until it's too late. And it doesn't help us at all to claim in the end, hey, we were the ones who saw it coming. It doesn't buy us anything. We still have to look at the results, even though we saw them coming.
Yeah, I think John Maynard Keynes has a quote about this, that even if you're right in a low probability event that most people don't think is possible, people are going to hate you for it. So unfortunately, this is a reality of things, but, I put my work, I just crossed 20,000 YouTube channel subscribers, so a pretty decent sized audience, almost 4 million views. But I want to thank you again for your time today, Erik. I really enjoy your work over there at Macro Voices. You do an excellent job on your podcast. It just keeps improving. It's come a long way in just a year. So I want to thank you again for your time. And if our listeners want to subscribe to the Macro Voices podcast, how do they do so?
You can go to macrovoices.com, or you can subscribe on iTunes. Just type in Macro Voices, all one word, and we publish Thursday evenings. Usually the show comes out around 8 p.m. It is for a professional finance and very sophisticated retail investor audience, so it's a little bit technical and advanced, but we find a lot of people really enjoy it. So come check us out.
Excellent. And I'll put the link to the excellent discussion you had with Tur Demeester about Bitcoin, the two-part discussion, in the info section.
Okay, fantastic. Thanks so much for having me back. I look forward to doing it again sometime.
Great. Have a great rest of your weekend.
Alrighty.
Please like this video, share it with friends and family, and don't forget to subscribe to the Wall Street from Main Street YouTube channel if you have not already done so. We're closing in on the 20,000 YouTube channel subscriber milestone despite YouTube censorship, and hopefully we'll be able to get to 30,000 or even 40,000 YouTube channel subscribers quickly if YouTube doesn't shut down the channel. If YouTube does shut down this channel, remember to also sign up for the Wall Street from Main Street email list that's on the wallstreetfrommainstreet.com website, and will tell you where the videos are going to be uploaded instead of YouTube. Also, if you really like the content and you decide that you want to give a one-time donation, you can go to the wallstreetfrommainstreet.com website, where there's different options for you to do so. Or you can become a Patreon contributor. Thanks for listening, and I look forward to providing you guys with some of the best information, analysis, and financial education available out there for free or paid.